we're going to use this information to do problem for sure 20 and 21. Chapman obtains 100% of Abernathy Company's stock on January 1st. As of that date, Abernathy had this trial balance. So it had some debt, accounts payable, it had accounts receivable, it had some assets, some cash, some retained or equity, stockholders' equity, equipment, inventory, land, and a long-term liability. During 2014, Abernathy reported net income of $80,000 while declaring and paying dividends of $10,000. During 2015, Abernathy reported net income of $110,000 while declaring and paying dividends of $30,000. Assume that Chapman Company acquired Abernathy's common stock for $490,000 in cash. As of January 1st, Abernathy's land had a fair value of $90,000, yet it's showing on the books at $80,000. So that's in excess of $10,000. Its buildings were valued at $160,000, where we're showing on the book $120,000. So that's an extra $40,000. So right now we're at an excess of $50,000. Do you guys get what I'm saying? And its equipment was appraised at $180,000. It's under $20,000. So that's a negative $20,000. Chapman uses the equity method for this investment. Prepare a consolidation worksheet entries for December 31st, 2014 and December 31st, 2015. So guys, like this would be, I wouldn't make a problem this difficult, but this is what I want you to know. The problem is not going to be on goodwill. You'll have multiple choice about that. The problem is on this, okay? So, we need to create the entry to record the consolidated worksheet entries for the end of the period. So let's first talk about some things we really need to get under. We need to know we purchased it for $490,000, and we have in here some excess land value, excess building, and our equipment is undervalued because we need to come up with an allocation, that amortization. So the first thing we are going to do is look at the $490,000. Then we're going to take our book value of the assets. So if we look at the 40 plus the 120 plus the 160, that's 220, plus the equipment, that's 420, plus the inventory, 510, plus the land, 590, 600,000, minus our accounts payable of 50, that's 550, minus our long-term liability. Do you see what I'm doing here of 150? That brings us down to a book value of $400,000. Does that make sense? So we take what we bought it for, $490, subtract from it the book value. It gives us an extra $90,000 of excess over book. It told us that the land, the fair value was $10,000 more on land. Land never is depreciated, ever, ever, ever. The building, it told us, is the fair value is $40,000 more than the book. Now we found out that there were 4 years remaining. Do you see how we see it here, 4-year remaining life? So we're going to need to take this excess $40,000 and divide it by 4 years, or $10,000 a year we have to allocate to the building. Now the equipment was under, the fair value was less than the book value. So we have to show a minus $20,000 on the equipment and allocate that equipment a minus $4,000 each year. So it really ends up being $6,000 of amortization each year. The 10 minus the 4. Does that make sense? So we can see here that the $90,000 we paid in excess, really a net of $30,000 is getting applied to accounts. The 10 plus the 40 minus the 20, which gives us goodwill of 60. Any questions on that so far? We need to do that in order to do the consolidated entries that we're getting ready to do, because we need to know how much to allocate to amortization. Okay? So, getting back here, it says to us, Chapman uses the equity method for this investment. Prepare consolidated worksheet entries for December the 31st and of 2014 and 2015. Now remember, this subsidiary continues to operate independently. But in order to consolidate our books, we've got to go through a variety of entries. The first thing we need to do is we need to get rid of the stockholders' equity section of the subsidiary. It shows us here that the stockholders section of the subsidiary had common stock of $250 and retained earnings of $100, right? So we need to show the $250 here. We're getting rid of the common stock, we're debiting it. It shows additional paid in capital of $50. It shows retained earnings of $100. So we're going to zero out those equity accounts, and we're going to zero out our investment account. See what I'm saying? Because we don't want to show those on consolidated books. This gets rid of the equity section. That's the S entry. If you get a multiple choice, it says, what does the S entry do? What are you going to say? Next, then we need to allocate the various fair value accounts. This is for the first year. We need to show the land gets increased 10, the buildings get increased 40. This is only going to happen right now. The goodwill gets increased 60. The equipment's getting decreased, isn't it? 20. And the investment in Abernathy is going down 90 because we got to get that off our books. We're getting that off our books by allocating it to specific assets. Then we need to show the elimination on our books for the $80,000 income accrual for 2014 minus that $6,000 amortization. So it showed us let me just see where I'm at. (2014) and 2015. So it shows us Abernathy reported net income of 80 while declaring dividends of 10, and in 15 it recorded income of 110 while declaring and paying dividends of 30. So what we have to do for the first year is reduce our investment account by what we already showed, the income minus the allocation. We need to get that off our books, the investment in Abernathy, and we need to debit that equity and subsidiary earnings. Remember, to consolidate, we need to look like one entity. Therefore, we need to get those investments off our books. Next, the dividends that we received from Abernathy of $10,000 at the end of 2014, we need to clean that up. So we're going to show the $10,000 investment in Abernathy, and we're going to credit our dividends declared. Then we need to recognize the amortization we have to take each period. Now, our amortization is based on that excess amount, which is up here. This excess amount shows the building. We're going to amortize $10,000 a year. The equipment gets a negative amortization of $4,000 a year. Okay? So we're going to show depreciation expense of $6,000. We're actually taking $10,000 on the buildings and we're minusing. It's kind of goofy. We're doing the opposite on equipment because it was undervalued. So technically, we're really only taking a net of $6,000 in depreciation. 10 of it being for the building, 4 of it being a minus on the equipment. So we've got to show that amount. Then, so that is, those entries are what we need to show for 1 year. And if I did something like this, it would only be for 1 year. I'm not going to create, it wouldn't be for 2 years. So know these entries. The various entries, the S basically gets rid of the stockholders' equity section and the investment account, a portion of the investment account. The A entry allocates the various fair values to specific accounts. The rest goes to goodwill. The I entry gets rid of the income and any amortization. The D gets rid of any intercompany dividends. The E shows our allocation for each year. Okay? Now, after that, it asks us to do the same thing for 2015. In 2015, Abernathy reported net income of $110 while declaring and paying dividends of $30. So again, in 2015, to make the consolidated financial statements adjusted to show the correct numbers for 2015, we're going to have to clean up the common stock and additional paid-in capital. But look at the retained earnings, guys. In the previous year, the retained earnings were $100,000. Do you see that? This year on the books, the retained earnings are $170 because we have to take into account the income they made in this year minus the dividends they paid out. That make sense? Then, so we subtract our investment in Abernathy by that same amount. So again, we have to adjust the books based on what's happened during this period. Then we also need to clean up, get rid of any create the allocations for the various assets. Now, can you see these allocations take into account what we've already done? Do you see how our equipment is down at a minus at $16,000 here to adjust for what we've done in the previous year? Our buildings are sitting at 30 increase. Do you see how last year they were sitting at 40? Do you see our equipment was at 20